These are the best markets to buy rental properties right now in late 2025. Today, we're telling you where to invest in real estate, whether you live in an expensive area or just looking for a new market with great wealth building potential. This is an absolutely essential decision to get right. So we've looked at all the data, and today we're revealing 9 of our favorite places in the US to buy properties right now. Hey everyone, I'm Dave Meyer, head of real estate investing at BiggerPockets, and today's show is an absolute fan favorite. Every single time we do it, we get a ton of positive responses. So we're doing it again. We are running this one back. And it's a great time to be making this list of best investing markets because if you've been paying attention, right now, the entire housing market is changing. Some areas of the country have more properties for sale and sellers that are more motivated to negotiate on prices than they did the last time we talked about this topic, which was back in April. So I'll share a few markets that I really like right now. And I also have our regular guests for this show on today. We have Ashley Kerr and Henry Washington here to add their favorite markets to the list as well. Ashley, how are you?
Thanks so much for having me back, Dave. I always love getting a good homework assignment.
Yeah, we made you do a lot of work for this show. And if anyone hears just some hammering in the background, Ashley's just being a very authentic real estate investor today, podcasting from an active construction site. So please bear with us.
Yeah, my live and flip.
These are the realities of being an investor. And we're bringing it to you on the BiggerPockets podcast. Henry, how are you doing?
I'm doing well, sir. Thank you very much.
Good. Well, I'm glad you're doing well because I'm going to pick on you and make you go first. Before you name your 3 markets, what was your philosophy about picking markets? Like, do you have any overarching theory about which markets work in this kind of market we're in right now?
My thought process behind selecting these markets were, where are some places that are places where maybe people would enjoy living, or major metropolitan areas where you can still find affordability, you can still get cash flow, you can still get growth and appreciation. So I tried to mix it up. Affordable house pricing, so under the national average, and where rents were strong. And then I did a little deeper digging to figure out which ones of these cities were like investing into the city themselves in terms of jobs, in terms of infrastructure, because that shows that, hey, we've got jobs for people, we've got growth for people, and we've got affordable housing and great rents, which is what you're looking for.
That's great. So are you saying these are going to be places that are affordable and the average listener will have heard of this city before?
Yes.
Okay.
Absolutely.
Maybe just hit us with your first market here.
This is a market that I feel like has been like trying to tap me on the shoulder over the past years, either through like people I know that invest there. People love visiting this place. I've never been, but looking at the market dynamics, it looks good. That's Columbia, South Carolina.
Oh, South Carolina. It's hot right now. Very hot right now.
Yeah.
How has it been tapping you on the shoulder? What's it been saying to you?
It's been saying that you should come look at real estate here, because I have, I know several investors personally who invest in and around the South Carolina area, and they say nothing but great things about it. Every time I talk to you about South Carolina, you say great things about it. And so, and I'm a big North Carolina fan in terms of investing. So, might want to check it out.
All right. Well, tell us a little bit more about the details here, because you said it was affordable. So what's an average price point here?
Yeah. So median price is about $250,000 for a home. Median rent is $1,623. And so I think with those numbers, you can potentially get cash flow. Now, I'm not saying $1,650 a month covers $250,000 mortgage. What I am saying is that with a median price of $250, you can find things that cost less than that, but you've got pretty strong rents at $1,600 on a median rent price. So that's a 0.65 rent to price, which is pretty solid. Vacancies less than 10%, unemployment less than 4.1%, and it's had positive population growth and positive job growth over the past several years. Another reason it's cool, landlord friendly. So you're able to operate as a landlord a little easier in this state than some other states. But other things I like is the median insurance is around $3,000 and median property tax is less than 1%. So
nice.
It's pretty solid.
I like that.
And you are in a market where people enjoy to visit, where people enjoy to live. You're around other major metropolitan areas. And so I think this is a nice, solid pick because you can find cash flow if you look hard enough. It's affordable compared to the types of jobs that are there. If you look at the infrastructure, you've got a $50 million downtown revitalization project going on. So the city is investing more in the downtown area, trying to bring that back to life. You've got a 500-acre innovation district being built, and it's being supported by the University of South Carolina. So there's a lot of investment going into the community. There are jobs in healthcare, in government, and in technology, all of which are solid sectors to be looking for. Because a lot of the times when you look at job growth, you want to pay attention to the industry those jobs are in, because jobs can go away if technology improves and maybe jobs get shipped overseas, or maybe jobs go away because of AI. So you want to pay attention to the types of jobs because you want jobs that are going to continue to be around. And so I think this is just a solid market.
Ashley, what do you think? Are you buying what Henry's putting down, or is this just a trash pick?
Well, I actually went towards South Carolina market. So I'm headed towards the Carolinas with one of my markets too.
Was it the same one, or do you have a rival South Carolina market?
I have a rival South Carolina market.
Oh, let's hear about that. I was going to go with all three of Henry's.
So mine is Greenville.
Oh, okay. Tell us about it. Tell us specifically why it's better than Henry's pick.
Henry was very prepared today. He went very in depth on this. So just based on that, he may have a better knowledge. He may have a better area. But I went with Greenville, South Carolina. And one of the reasons I looked at this was because I was looking for appreciation. So of the three markets, I found two that I want to look for appreciation, but a little bit of that affordability. So the first one was Greenville. And I also agree, I feel like there's a lot of opportunity on the East Coast. As always, I never want to be on the coast because I don't want to have a super high insurance cost. So Greenville is, I feel, far enough away where it's not going to be hit with crazy insurance. So steady price growth there. There's been recently 3 to 4% year over year. Right now, the median home value is around $340,000. And for rental demand, it's pretty good. It's around $1,700 to $1,750 and consistent 2 to 7% annual growth for the rental rate there.
All right. I mean, that also sounds like a great market. But Henry, are you going to counter Ashley here?
Well, yeah. So I think the thing that makes my South Carolina market better than Ashley's South Carolina market is because people have heard of my city. Yeah, people have heard of Columbia, South Carolina.
That's true.
There's that. But in general, South Carolina as a whole is just a good state, especially when it comes to jobs. Because as I was doing the research, they're in the middle of a hiring boom right now, and they added almost 9,000 new jobs in July alone in the state of South Carolina. So
that's
just a strong state in terms of affordability and in terms of potential for cash flow mixed with potential for equity. People keep saying you have to pick one or the other. There are markets like this where you can get both.
And I think too, there's a lot of different industries coming in or already there, that it's not reliant on just one manufacturer or industry.
All right, these both seem like really good markets. I like it. I just think South Carolina generally is going with a lot of trends people seem to want to find. And there's a lot of demand in markets where it is relatively affordable. There's great jobs, but also I think the high quality of life thing that both of you highlighted about these two markets are really bode well for future growth and a lot of the investment you're talking about. All right. Well, since each of you have gone, I will just go and throw in one of my markets. And Ashley, I promise we will give you a opportunity to explain your philosophy. But my philosophy for the three markets that I picked were all, one, trying to protect against downside risk. We're in a weird market right now where certain markets are going to decline, some are going to grow. And so I really wanted to find places that have good long-term potential, but are not at risk of any sort of significant declines. I also want to be able to find on-market cash flow. That is something that is important to me as an investor, and that's why I'm recommending it to you. And therefore, my number one market that I am recommending is Des Moines, Iowa. I know, not something that we talk about a lot on this show, but Did you guys know that Des Moines is actually the fastest growing metro area in terms of population in the Midwest, which does not mean it's fastest growing as like some places in Texas or Florida, but I love the Midwest from housing market fundamentals, and it is the fastest growing population in the Midwest. So that's something I really like. The other thing that I like is I think like Henry, is kind of cute that your market had like, $50 million investment, and it's really nice. But in Des Moines, there was a $3 billion, for those who are keeping score, which I clearly am, that is 60 times more than Henry's market investment in the downtown area.
One of the markets I picked has $1 billion investment, and I thought it was going to blow everyone else away, but that's double mine even.
What kind of buildings are you building in downtown Des Moines, Iowa?
I honestly have no idea, but I will say that between that and the 6% population growth just since 2020, which is a lot, that might not sound like a lot, but populations don't generally grow all that much. So that one is really good. And then the other thing that I like about Des Moines, which is going to be a little bit controversial, is that prices are somewhat flat. Now, we're in this weird market where you kind of have to decide as an investor, like, do you want to invest in the markets that are still growing? Or are you trying to find the markets that have good fundamentals, but have a little bit softer pricing? And for me, because I just love hedging everything, a flat market is basically right in the middle of that. Like, I don't feel like it's growing at an unsustainable rate, but with inventory going up and relatively flat prices, that means you're probably going to be able to negotiate in a market that has a lot of good stuff going on long term. And that means I'm probably going to be able to get some better deals, which is why I like Des Moines.
Every time I talk to somebody that is an investor that lives in or around Des Moines, they always speak so highly of it. I know absolutely nothing about Des Moines, but it sounds like it's going to be the Dubai of the Midwest if they're spending $3 billion on downtown. That's intense.
This week's Bigger News is brought to you by the Fundrise Flagship Fund. Invest in private market real estate with the Fundrise Flagship Fund. Check out fundrise.com/pockets to learn more.
Ashley, let's go to you for your second market. And, we skipped ahead before, so I didn't get to hear about your philosophy for picking these markets. Maybe tell us how you picked these three, and then tell us what your second market is.
Yeah, so I really went for appreciation, but slow and steady appreciation, almost kind of like what you said, Dave, where it's not super drastic, because like Austin, Texas scares me, as in prices went crazy. There was so much growth there, and now it's just not completely, but it's tanked a bit there. And so I don't want that to happen. So I'm looking for more consistent growth. But cash flow, I do agree, is very, very hard to find in many areas. So for me, I'm looking for a little bit of cash flow, but more for appreciation. And I also want an area that's, like Henry pointed out, no one's ever heard of the town that I picked, as to somewhere where it is not as obvious of a place. So, if I named off all of the towns that my properties are in, nobody would hear of them, because it's not even, I have 2 in the city of Buffalo. The rest are in all these other smaller neighborhoods. So I root for the rural towns for where the cash flow, the opportunity, and the appreciation is. So I did go with, for my next market, is McKinney, Texas, which is outside of Dallas, and it is more well-known. It's actually a prominent neighborhood. But what I'm looking at is the rural areas outside of McKinney, because McKinney is where it's getting this $1.5 billion development of like a plaza and all this stuff coming in to that town. So I looked at the outskirts, the neighboring areas up there.
I'm looking up the map here because I've heard of McKinney, but I didn't know exactly where it is. It's not that far outside of Dallas, right? Like, this is still within the Dallas metro area. So it's not like you're going completely rural, right?
So some of the ones that I looked at that are like neighborhoods of this are Princeton, Texas, Little Elm, Texas, and Lavon, Texas. Someone's going to say I'm saying that wrong, but like Princeton, Texas is one of the fastest growing cities in the U.S. with 30% annual population growth since 2023. Wow. The population, it doubled from 17,000 to 37,000. And the same with Little Elm, Texas. It went from 26,000 in 2010 to 46,000. Little Elm also has a lake there too. So there's lakefront property, different, things like that. So I do like the ability to do different strategies in the market. So if long-term isn't working, to switch to short-term.
I like it. This reminds me a lot of all of our mutual friend, Kathy Fecky, who has been investing in North Dallas for a very long time. So I feel like I've just been indoctrinated into believing that North Dallas is a good place to invest. And now that you are bringing this one, I'm doubly intrigued.
Well, anything that Kathy does, it just, puts that golden seal on it. So,
well, I'm buying it. I like the idea of this. I generally like the idea of like, it's not even like a secondary city, but it's like almost like satellite neighborhoods to big cities. A lot of times you're just able to find, if you can really understand the market and study it, you're able to find areas that are in the path of progress, even in a city that's already relatively expensive, like Dallas. Dallas on a national basis, actually, for a big city is not that expensive, but like you can find some markets like this that have the potential to reach maybe the median of the whole metro area, but aren't yet there. And if it has strong population growth and strong demand, like there's a pretty good chance that that's going to happen.
Yeah. And I think part of it is like you want good quality tenants. Like I started out buying $20,000 duplexes that just were low, income areas. They were low quality tenants, didn't take care of the place. I spent so much time, dealing with headaches and things like that. And I ended up selling all of those properties. But it was a really big lesson that it's worth it to pay more for a property, maybe have less cash flow, but not have to deal with those kind of headaches that come with some of those $20,000 properties. So I like the idea of a higher end city, but finding the people that can't afford to actually live in the city, but want that same good quality of life. And they'll move outside it just a little bit. And I want to be like that person that's providing that quality housing for somebody who, can't afford to live in the city.
Awesome. Great pick. Thank you, Ashley. All right, Henry, what's your second market?
My second market is Cincinnati, Ohio.
Oh, okay. It's been a very popular market the last couple of years.
The numbers are strong. I can see why. Median price on a home, $272,000.
Nice.
I mean, for a major metro, that's awesome.
Yeah.
But median rent, what do you think the median rent is?
$1,500?
$1,500.
Almost $1,900.
Wow.
$1,868. The numbers are nuts, man. So that's a 0.69% rent to price, which is amazing. Vacancy, 7%. Like, that's really good.
Pretty good, yeah.
Unemployment, 4.9%.
That's interesting. I would have guessed higher than
too. Absolutely. I mean, I can see why people are choosing to invest here. If you're just looking at pure numbers and you want a city that you've heard of, you want city infrastructure, city jobs, like this, I can see why it makes a lot of sense. Because you can, like, if I see 272 on the median price with 1,800 on the rent, like I already know there's cash flow on the market. I already know there's absolutely cash flow if I go direct to seller. And to be able to find that without having to go super rural is pretty cool for people. So if you're considering a market and you don't want to be out in the outskirts and you want to be where people are going to live, like this is it's a heavy contender. 5-year price growth, approximately 56%. Landlord friendly, which is what we're looking for. Property taxes at 2.5 or $2,600 at the median, and property taxes again at about that 1%, which is fairly reasonable.
Yeah, 1% is the average nationally.
Yeah, the numbers are strong, and usually you don't see numbers this strong in major metropolitan areas. So I just think that I couldn't overlook it again this time.
Well, I would say it's a good market, except that mine is better.
Well, let me throw this number out here. I'm going to try to redeem myself. So as I dug a little deeper into what's going on in Cincinnati and are people enjoying that place, Cincinnati's spending $800 million on their downtown overhaul.
All right.
So, I mean, better than 50, not $2 billion. So it is not the Dubai of the Midwest. It's more like the, I don't know, what do you call it? Maybe like the New York City of the Midwest.
Okay.
You know, it's $800 million. And they're doing big upgrades, spending $470 million on renovating the stadium where the Cincinnati Bengals play, because the Bengals have agreed to stay through 2036 in Cincinnati. And so that's a good sign for tourism and all of the things that come with having an NFL team in the area. So they're spending money. They've got jobs. They've got job growth. They've got population growth. They've got affordability, and they've got great rents with good cash flow. Yes, I mean, it's a colder market. You've got to deal with that. But if you can get past some of those things, especially if you live near or around the Midwest already and you're looking to get started, you don't have to pick some rural town you've never heard of to be able to afford cash flow. You can get it in a place like Cincinnati.
That's pretty good. Now, so I like Cincinnati. And the reason I was joking that it's a good market, except mine was better, is because I was actually deciding between Cincinnati and a city that has a lot of the same fundamentals, but is just over the border in Kentucky. I picked Louisville, Kentucky, which I only recently learned are close to each other because my geography is absolutely terrible, but they're actually very close to each other. And they're very similar on paper. And I think for many of the same reasons that Henry just shared for liking Cincinnati, like this is a large metro area. It has slightly worse cash flow prospects versus Cincinnati, but it's a little bit cheaper. It has a little bit better unemployment rate, but we're just splitting hairs here. The one thing I will say about Louisville, though, that sort of like tipped me towards that over Cincinnati is that it's just growing really quickly. Like home prices are still up 5 or 6% every, like the last couple of years, and they've continued to do that. Plus, there's this stat that I was looking up that I think is kind of important. Louisville contributes 40% of the state's GDP, which means that a lot of the state investment and infrastructure goes into Louisville, which I like. It just means that they're going to continue investing there. Plus, also, if you ever go out with me, you know I like drinking bourbon, so I'm partial to Louisville and Kentucky in general, so I just picked it over Cincinnati for that reason. So I won't dwell on that because I think Henry did a great job explaining a pretty similar market, a lot of the same things to like. Those were each of our second picks. Just as a reminder, we have McKinney, Texas coming from Ashley. We have Cincinnati from Henry, and I brought Louisville, Kentucky. Henry, you went first round. Ashley, then you went second. So I guess I will go first in our third round. And I'm going to bring a little bit different kind of market. I decided to mix it up because I do talk a lot about the Midwest, but I am bringing one in the Northeast. It is Hartford, Connecticut. And I know a lot of people are probably thinking that's a relatively expensive market, and it is, but I want to just frame this as sort of relative affordability because Hartford's median home price is about the same as the national average. It's like $420,000. But when you think about the affordability compared to the big cities around it, which the two big cities around it are Boston and New York, two of the least affordable cities in the entire country, this is a city that's right in between those two massive economic engines and is relatively way more affordable than those other markets. And so you see a lot of people from the New York metro area, from the Boston metro area, moving to Connecticut in general. And Hartford has just seen prices going up. It has seen rents going up. And I think it's going to continue to be a pretty strong market going forward, even though it doesn't fit the normal criteria that I use to pick markets on this show. What do you guys think? We never talk about the Northeast. Are you guys interested in something like this?
So one of the things I love about Connecticut in general is there's a lot of cash flow out there. I mean, I've got a buddy who's been on this show that he actually lives in New York, but invests in Connecticut because the cash flow numbers are so good. And sometimes I've seen the returns, or he's told me about the returns he's getting in terms of purchase price to what he's actually renting these units for. And it had me looking out at that market because there's great cash flow out there.
All right, so that was my final market for today's show, but we have two more from Ashley and Henry. Henry, let's hear your last market.
All right, my last market is probably the least recognizable city of the three that I chose, but most people will have heard of this market. I chose it because of its proximity to more recognizable cities. And it's in one of my favorite states for investing, which is North Carolina. So I chose Greensboro, North Carolina. Some of the numbers that Greensboro has are $251,000 for the median price, which is fantastic. And then you've got a $1,600 median rent, which is very good in terms of being able to get to some cash flow, especially cash flow on the market. It is landlord friendly. Insurance is pretty normal, similar to the other markets we talked about. Property tax is also very similar at that 1%. But what I really like about this market is its proximity to markets like Raleigh, North Carolina, or Charlotte, which are very popular markets. And because they're popular markets, pricing has gone up in those markets. So those markets are substantially more expensive. And because they're getting more expensive, people are now moving out of those areas. Like the people who have been in those areas for a longer period of time are now moving towards more of this market like Greensboro. And so what I like about that is when I dug into what types of jobs and what types of money is being spent on infrastructure around the area, you've got a company called Jet Zero Aerospace, not to be confused with a Jet 2 holiday, which is a whole different.
I wouldn't have confused those. I haven't heard of either of those.
That's because you don't spend your time on social media like I do. But everybody else knows nothing beats a Jet 2 holiday. So Jet Zero Aerospace has a mega project. They're spending $4.7 billion on the Triad International Airport, and they're building an aircraft manufacturing and R&D center that's supposed to bring 14,500 jobs to the area. So if you're looking for a place that has proximity to major metros, similar to the market you just talked about, but has potential for growth coming in the future with these large investments. This is a place where you can go, you can buy a property now affordably that cash flows now in the market, and then you can get some appreciation when these jobs start to come, when people are trying to live closer to this hub where this 14,000 jobs are going to come from, and then you'll get the appreciation on the upside. You can now go to this market, you can buy now, and it makes money now. And even if these jobs don't come, your property's still going to make money. And then you can get the appreciation as the infrastructure starts to come in, as they develop this airport. Plus, there's other companies that are also building and expanding in and around this region. And so, I think that this market of my three has the best potential for growth in terms of your investment growing. You can get cash flow now. You can buy a property that you can flip now. But if you can buy something that cash flows now and hold on to it, you have some potential upside in the future. And even if that upside doesn't come to fruition, you still got solid market dynamics in terms of steady population growth and steady job growth and steady home value increase. So
I love it.
If I were to pick one of the three markets that I brought today, and I had to buy a property in one of those three markets, this is the one I would choose.
All right. Ashley, hard act to follow. You got to go last though.
Yeah.
So let's see what you got.
Well, this one I left up to the people. I put it out there and I said, what market do you want me to analyze? I put it out on my Instagram, the little question box, and I let people drop in all these markets. And there was 50 responses, okay? Everybody said different markets except for three people. Three people said Toledo, Ohio. So that's what I went with for my last one is Toledo, Ohio. I knew nothing about this market except it's in Ohio. It's the fourth largest city in Ohio. And it's a landlord-friendly state. So those are the things that I knew about it. And these are the things that I learned about it. Also, it is only having a $53 million downtown development coming in. So very, very, very small compared to the other ones we have discussed. So basically what I've learned is it's more definitely a cash flow play than it is appreciation. So median home price is $188,000. The rent $1,400. So the rent to price ratio is 0.75%.
Yeah.
The vacancy rate is 8%. Unemployment rate 6.7%. The population is a little over 500,000. But other than that, there's not a lot of population growth, not a lot of appreciation growth, not even really rent growth really happening in this city.
Okay. So are you standing by this one after you've done your research?
I think this goes along with how I started out. I went for cheaper areas, cheaper markets, cheaper, rent, and I'm going to stay away from this market.
Yeah, I'm kind of with you.
When I first started investing, I was all cash flow. And I'm like, this is how I'm going to get financial freedom, is living off my cash flow. As time has gone on and I've seen all this equity built up in my properties, I was like, wow, this is the real wealth, not the $250 in cash flow for getting up to, 50 units. Like, oh, okay. It's the equity that sit in those properties over time. So I don't see a ton of appreciation. I do like the cash flow. So maybe it's a great starting point for someone as to getting started in real estate, and then 1031 exchange that property into a different market at some point. But I'm going to say for me, it's a no, because there's very, very little appreciation unless you're planning to just hold this property for 20 to 30 years. Then you're going to build equity in that. Your mortgage is going to be paid off. So if you really want a long-term play, then this could work for you.
This one would be a no for me as well. But here's why and what would make it a yes for me. It's a no for me because of the job growth and population growth situation. Like that, what I'm seeing from the numbers you gave me is that people aren't steadily moving there, and there maybe isn't jobs for those people if they do move there. And what I'm looking for when I'm picking a market to invest out of state is I want to pick a place where people are moving there because they want to live there. And when they get there, there's good jobs for them. Because that lets me know that if I spend some money now, that's a good investment for the future, because history has shown me that the population has been growing and that the jobs have been growing. And I'm not saying that has to be the dynamic in every market you invest in. And so what would make this a market that I would consider is if I was researching that city and I was seeing that, okay, maybe they inked a deal like Dave and I just did the Cash Flow Roadshow, and we went through Kenosha and Racine, which are small towns a lot of people maybe have never heard of, and they don't have a ton of appreciation, and they don't necessarily have a lot of population growth. But what they do have is they just inked a deal with Microsoft, and we drove by and saw where they were building this massive, what looks like to be a data center. And so we know that jobs are coming in the future. And if jobs are coming in the future, that could be an attractant for people to want to live or move near that area. And so that would show me that, okay, there may not be positive population growth over the past 5 years or positive job growth over the past 5 years, but because these companies are spending a massive amount of money in that area, that there could potentially be upside for that in the future. And we know that that deal is inked, and we know that they've broken ground because we saw those things for ourselves. So if I saw something like that where there was investment in this community for the future, then maybe I'd consider it. But not having something inked where there's companies coming to the area to bring jobs, where the city's not spending a ton of money, there's no population growth really, and there's no job growth, then you're just literally investing for pure cash flow right now. And I'm not saying investing for pure cash flow is bad. I'm just saying that that's the only benefit you're going to get outside of the tax benefits. And I want to get paid as many ways as my real estate will pay me. So I want the appreciation, I want the tax benefits, I want the depreciation, I want the cash flow, and I want the equity. I want it all, baby.
Yeah, I know you're a greedy man, and I like it in this way. No, that makes total sense. I just think you could probably make money. I think you can make money in any market, but just when you're looking at on paper, you could probably do better. Like a lot of the ones, I think the eight markets that we shared before this one offer stronger fundamentals. Doesn't mean you can't make money there. I think for me, I invest in some places for cash flow, but I need the rents to be going up. And that's to me the thing you said, Ashley, about this market that makes it not interesting to me is like, it's not appreciating and rents aren't going up. It's like, what are you doing there? I mean, I think like
because your property taxes, your insurance,
everything else going up.
Exactly. Yeah. So like you're probably going to be losing money to inflation at that point. Like it's just not, to me, that's not worth it. If you were buying in a market like the one Henry talked about in North Carolina, like where rents could go up and it can be like it's a solid cash flow market and it can turn into a great cash flowing deal, like I would invest in that even if the appreciation is not amazing. To me, it's like a spectrum, right? Like if one of the two has to be growing, either property values have to be growing or rents have to be growing a lot. But if you have zero, neither of them growing, it's just not very exciting. All right. Well, sorry, Instagram, we don't like your pick.
I was just going to say, if there's something we're missing here about Toledo, Ohio, and you're watching on YouTube, please put it into the comments and enlighten us as to why we should invest there.
All right. Well, thank you both for bringing these markets. Hopefully you all learned something, not just about some potential markets that you can invest in, but just the way that we think about evaluating markets, whether you're looking at a neighborhood within your market or actually looking to identify new markets out of state, which I think more and more people are going to be doing while we're in this interesting market that we're in. Well, some markets are not doing great. Some have great opportunities. And for a lot of investors, I do think it makes sense to at least explore whether you can get better returns investing out of state than you can in the markets that you're looking at. I do a little bit of both, and I think it's a great way to diversify your portfolio. And hopefully this episode will help you figure out if it's good for your portfolio as well. Henry, thanks so much for being here.
Thank you very much, sir.
And Ashley, thank you as well. We appreciate it.
Yeah, and thank you for having me.
And thank you all for listening to this episode of the BiggerPockets podcast. We'll see you next time.